Welcome to the Momentum Investments Investment Matters Conference. This is the annual conference to showcase new thinking, initiatives, and thought leadership. The overarching theme for this year's conference is empowering the future. Building investment success and leaving a legacy by future-proofing your investments is something that's very personal for all Momentum Investments clients as well as their advisors. And that's why the company's purpose statement is, with us, investing is personal. They understand how important it is to achieve planned investment outcomes. And over the next 3 days, this is where you'll have an opportunity to fully understand Momentum Investments as they showcase their investment management capability. That will be exposed on day 1. And of course, on day 2, we'll deep dive into alternative investments. On day 3, we'll explore their multi-asset class solutions. Now, this will give you the opportunity to fully immerse yourself in the mandate of Momentum Investments, from understanding the investment purpose and, of course, learning more about the people behind these funds. On a more professional note, we also applied for Continuous Professional Development, CPD. So please be sure to watch the full sessions and add your ID or FPS number to the CPD section so that we are able to verify your attendance. The CPD certificates will be mailed to you after the financial planning institution's accreditation is finalized. As we get into the excitement over the next 3 days, we want your interaction and your questions. So go ahead. Feel free to post your questions to the speakers in the questions and answers section, and you're more than welcome to use the chat function during these sessions. As we get excited and get ready to start the process and program for today, allow me to introduce our first speaker. Jeanette Marais, CEO of Momentum Investments and Deputy CEO of Momentum Metropolitan Holdings, will introduce the conference and highlight some of the key focus areas as well as achievements of the business thus far.
Thank you, Gugu. Good morning, everyone. Welcome to our 2021 Investment Matters Conference, and thank you for taking the time to join us today. This conference is always a proud moment for me because it is an opportunity to showcase the thought leadership and the talent of our team and to explain how we are leveraging off these to ensure that there's a future for all. We are passionate about continuously strengthening our offerings and investing in research and strategies that gives you, our valued clients and partners, investment solutions that will enable your success. When building solutions and strategies, we place a great emphasis on the powerful enabler that technology can be. But with us, investing is personal, and we believe that no machine can replace the value of the human touch in our processes. There's a quote by author Thomas Fuller that says, "He that plants trees loves others beside himself." I believe this quote captures the heart of Momentum Investments beautifully and makes the theme of our conference, Empowering the Future, even more fitting. Our vision towards sustainable investing is a holistic one that empowers communities and the generation that will come after us. Another important element in our efforts to assist and ensure a healthy economy for future generations is our efforts to vaccinate as many people as possible. Although not directly related to our conference, I would like to spend a few moments to discuss the topical issue of vaccination against COVID-19. The Momentum Metropolitan Group have a huge focus on and involvement in the National Vaccination Program. Right from the start, we played a central role in negotiating with and supporting government to speed up the process of vaccinations. In fact, we were the first life insurer who had 5 mass vaccination sites approved all across South Africa. Today, we operate 5 of these sites for the public, and we have already vaccinated over 250,000 people. We analyzed our Momentum COVID death claims over a recent 2-month period, during which an amount close to R1 billion was paid in claims. And we picked up that less than 2 out of every 100 of the lives lost were fully vaccinated. In other words, 98% of these deaths could have been avoided if these clients were vaccinated. Here's some further proof in our statistics. In the first wave, 8% of the COVID-19 related death claims we processed came from frontline healthcare professionals. These were among the first to be vaccinated from 17 February this year. This has since decreased to 2% in the third wave. With the efficacy of vaccines not at 100%, it is possible that as the pandemic continues, there may be more death claims from vaccinated people. However, we would like to stress that based on our experience, the risk of severe illness, hospitalization, and ICU care and death is significantly less in fully vaccinated people. If one considers the claims experience relative to the percentage of the population that is likely to be vaccinated, according to our claims experience to date, you are 50 times more likely to die from COVID-19 as a non-vaccinated person compared to a fully vaccinated person. So let me tell you a story to illustrate this. If you have 100 friends and half of them are against getting vaccinated, and the other half, of course, are vaccinated, and all your friends become infected with COVID-19. Statistically speaking, all your unvaccinated friends will pass away due to COVID before more than one of your fully vaccinated friends will. Under the income protection products, which caters for temporary illness, almost 60% of COVID-19 related claims Momentum paid during the first wave came from healthcare professionals. This reduced to around 30% during the third wave, a reduction that can be attributed to the initial vaccine rollout of which the healthcare practitioners formed part. Vaccination works, full stop. We know there's going to be a light at the end of the tunnel if more people are vaccinated. We encourage vaccinations because it is the responsible thing to do, and this has a real and lasting impact on mortality, but ultimately the well-being of our economy. If we can get people working and economically active, we will be in a far better position to empower the future. At Momentum Investments, there are so many other areas we are passionate about where we want to make a difference. We also know that we have a responsibility to make a difference because we can. If you look at our presenters, it is representative of our business. We have talented teams of women as well as diverse talent. And I believe that by tapping into the diversity of the people in the country, we are stronger and will have more relevant solutions to benefit everyone. We therefore invest heavily in our transformation initiatives, with one of the newest being the launch of our internship program, Pambile, aiming to develop people to one day become leaders in investments. As the CEO of Momentum Investments, I'm proud to have a team that is so driven towards responsible investing practices, ESG initiatives, and all the opportunities that accompany these. Throughout the conference, you will hear a lot about our focus in these areas. Our belief about responsible practices is at the core of what we stand for and aligns to the greater group's practices and values. Our approach towards sustainable investing is simple. We want to do well by doing good. We put the heart back into investments. You would have heard the phrase, if you give a man a fish, you feed him for a day. If you teach a man to fish, you feed him for a lifetime. It follows then that we do not only help clients to reach their goals, but empower and equip them to reach a state of financial wellness and success for their future. Some of the topics of the conference reminded me of how proud I am to be part of a business that is doing so much good. Our impact fund, with the underlying portfolios being our Momentum Alternative Energy Fund, the Momentum Social Infrastructure Fund, and the Momentum Diversified Infrastructure Fund, targets underlying assets that have a positive societal impact through addressing social and environmental challenges. We have seen through the projects we invest in, ranging from student accommodation to alternative energy to shopping malls, that help integrate communities and keep our economy moving forward, that responsible investing produces so much more than just a return for our investors. It creates jobs, integrates communities, protects our planet, promotes education, and ultimately empowers the future. Over the next 3 days, you will hear from our experts about how we are thinking about the future, and we will unpack the strategies and capabilities we are using to get there. Today, the discussions will have a focus on our investment management capabilities and what it means to become an investment manager of the future. After all, life and lessons can only be understood backwards, but we have to live forwards, so we are putting the work in now to empower our future. It is fascinating to see how the team is building and improving our solutions to be innovative and future-proofed so that we can plant those trees for the future. When you hear our alternative investments update, there will also be discussions about navigating the maze of this landscape to make sure we come out of it with the best solutions for our clients. Additionally, as I've mentioned, we have a large focus on investing with purpose and impact. On the last day of the conference, we focus on pulling this all together as we start to delve into the future expectations and trends of multi-asset class portfolios. This is the one place where what you would have heard over the preceding 2 days comes together into our solutions. Listen to global and our local experts describe key themes and trends that they are thinking about and that will enrich and enhance portfolios into the future. At Momentum Investments, our holistic approach is encapsulated in our outcomes-based investment philosophy, where we place ourselves in your shoes and create portfolios that talk to your needs. However, we need to empower ourselves, those around us, and those that will come after us to ensure that our belief about the future is correct. So how is Momentum Investments empowering the future? Well, I believe we do this through our positioning statement. With us, investing is personal. For instance, building a successful portfolio to leave a legacy is personal, and our team has a personal conviction to develop optimal solutions that can make an impact. To ensure we are future-proofed, we also employ technology but remain true to our core belief that the value of human connection and financial advice is personal, and we must never lose that. In fact, one of our key themes in the business is strategic partnerships, and these enable our success. Momentum Investments is empowering the future and contributing to our greater purpose to enable businesses and people from all walks of life to achieve their financial goals and life aspirations. We help them to invest in their future so that they can have one. Thank you.
Herman van Pappendorp, the head of investment research and asset allocation, illustrates one important way in which we future-proof investments by making widespread use of scenario analysis in our strategic asset allocation. Now, he discusses the main macroeconomic themes likely to play out in the coming years and then assesses the probable return implications for the different asset classes within 3 different possible scenarios. His team's work informs fund managers' thinking on how to navigate their funds into the future.
Thanks, Gugu. The American baseball legend Yogi Berra hit the nail on the head when he said, "It's tough to make predictions, especially about the future." So how does one deal with this reality when you're in the business of investing other people's money to provide them with a required outcome in the future when that future is unknown? Well, our basic premise at Momentum Investments is that because the future is unknown, we have to be humble enough to acknowledge that our own forecasting ability is as limited as everybody else's. We thus have to guard against putting all our investment eggs in the proverbial one basket by foolishly backing only one specific future envisaged outcome when we construct portfolios. We should not disregard the large likelihood that any expected outcome may indeed not materialize. So how do we future-proof our investment process and therefore your investments? Well, we do this by consistently using scenario analysis as an integral part of both our longer-term strategic asset allocation and shorter-term tactical asset allocation methodologies in order to determine a realistic range of future possible outcomes. In this way, we try to future-proof our investment decisions as much as is practically possible against uncertain and unexpected outcomes. This also helps us in compiling a risk-reward matrix for all asset classes, hence allowing us to make a probability-based allocation to each asset class, incorporating at least parts of each of our envisaged scenario outcomes. In essence, we invest for the central, most probable scenario, but also take cognizance of the positive and negative tail risks incorporated in two other possible scenarios, a best case and a worst case on each side of a base case scenario. In our 5-year medium-term strategic asset allocation work, we attach probabilities to each of our 3 possible scenarios. In each of these scenarios, we first postulate what the main broad macroeconomic themes would be that will likely play out in the coming years. Then we determine what the likely consequences of these themes would be for the key global and South African economic and financial variables in each scenario. Finally, we assess the probable return implications for the different asset classes within each scenario. From this process, it becomes very clear where the risk-reward lies for each asset class across the 3 scenarios, and where our strategic asset class preferences and dislikes should be in our portfolios. So let's make this practical and discuss the scenarios that currently underlay our longer-term asset allocation process. Our base case scenario is called muddle through, to which we currently attach a 65% probability. Our worst case is called deflation, with a 20% likelihood. And our best case scenario is called reflation, with a 15% probability. We have identified 2 main global themes and 2 South African themes that are likely to be crucial in determining the respective outcomes across the 3 scenarios in the coming years. On the global front, these themes are, firstly, the relative success of the vaccination process across the world, including South Africa, and secondly, the future path of global fiscal and monetary policy. Let's start with the vaccination theme. In our base case, we expect vaccine rollouts to be uneven across the world, and for new COVID variants to cause sporadic disruptions in certain regions, impacting negatively on economic growth in these areas from time to time. In our worst case, vaccine rollouts falter as a combination of poor supply, hesitant demand, and falling efficacy against rampant new virus strains take hold. This causes widespread and more lengthy lockdowns around the world, resulting not only in a mere slowdown in global economic growth, as in our base case, but an actual contraction in growth. Contrast this with our best case scenario, where international solidarity enables an acceleration in vaccination rollout speeds, while vaccines also prove successful in combating any new virus strains, with positive implications for global growth. Now let's talk about the likely evolution of global monetary and fiscal policies in the next few years across our envisaged scenarios. In our base case, muddle through, shown by the blue lines for both developed markets and emerging markets on this slide, stimulatory policies initially forcefully counter the contractionary forces caused by COVID-19 and lockdowns. But the global recovery then becomes uneven due to differences in vaccination effectiveness, as well as a rise in protectionism to avoid over-reliance on global supply chains. Inflation also increases, and the initial removal of stimulus and eventual tightening of developed market fiscal and monetary policies causes slowing in economic growth to the long-term average growth rate in the outer years. China also encounters slowing growth as its policy focus shifts from growth at all costs to eradicate absolute poverty to common prosperity to improve social inequality. Although a moderate risk-on environment should support riskier assets in our base case, the removal of policy stimulus on top of challenging valuations are likely to constrain absolute global asset class returns. In our worst-case deflation, shown by the red lines for both developed markets and emerging markets, global policy tools prove ineffective to address the ongoing global contractionary forces associated with new COVID-19 variants and lengthy lockdowns. Although ultra-accommodative monetary policy stances persist in this scenario, real interest rates remain too high with falling prices, and spending and investment are thus continually postponed, with severely negative implications for economic growth. In such a deflation scenario, capital preservation becomes the sole investment objective, with risk-reward clearly favoring fixed income assets to growth assets. In our best case reflation, depicted by the green lines on these charts, policy measures are effective to negate the contractionary forces, and global growth accelerates towards its pre-global financial crisis trend. Higher consumer and business confidence facilitate a self-sustaining and durable growth recovery, which improves fiscal and debt ratios. As demand pull inflation picks up, global interest rates reset to a higher level. In such a strong risk-on environment, growth assets are likely to be the best asset classes. Closer to home, there are two South African-specific themes that we think will be vital in driving the performance of the local economy and asset classes across the scenarios. Firstly, the electoral performance of the ANC in the coming years, and secondly, the likelihood for the implementation of local economic reforms. In our base case, we expect the ANC to maintain a healthy majority, for some economic reforms to be undertaken by government and for some action to be taken against corruption. But the policy focus remains redistributional, and South Africa's growth potential remains constrained around the 2% level, as shown by the blue line on this slide. In our best case, the ANC loses some support, but still maintains a 50% majority. This loss of political support motivates government to undertake a more aggressive and effective economic reform strategy, and it also initiates stronger action against corruption. This assists South Africa's growth potential to reset to a higher level, shown by the green line on the chart, and enables the country's credit rating to gradually move closer towards investment grade in the outer years. In the worst case, the ANC loses its majority and is forced to govern in coalition with the EFF. This stymies any economic reform agenda, with South Africa's growth potential plunging towards zero, as indicated by the red line on the graph. A sovereign credit rating downgrade spiral ensues, and there is an increased probability of an IMF or a World Bank bailout. So let's now discuss the likely medium-term real returns that can be expected from some of the main asset classes in our portfolios across each of the three scenarios. It should be no surprise that growth asset classes like equities do best in our best case reflation scenario, where the combination of the strongest economic growth and the highest inflation support the largest profit growth, while growth assets do worst in the weakest growth and inflation deflation scenario. For cheaply valued South African equities specifically, potential returns should also benefit in reflation from investors' likely willingness to pay a higher valuation multiple in such a risk-on scenario, shown by the green bar on this slide, while returns in the worst case deflation in red should be eroded by multiple contraction in this risk-off scenario. While global equities are likely to experience the highest US dollar returns in reflation and the lowest dollar returns in deflation, the rand strength expected in risk-on reflation in the green bar should erode the rand returns from global equities in this scenario. In contrast, the rand weakness anticipated in risk-off deflation in red should add a bit to the rand returns here. Although the dollar returns from global equities in our base case in blue are expected to be lower than those in the best case reflation, the moderate rand weakness expected in our base case versus the rand strength in reflation results in a higher expected rand return outcome in our base case than in reflation for global equities. The main drawcard for investment in South African nominal bonds remains the high level of real yields available, which we think more than compensates for any actual or perceived fiscal and country risk premia. Not only are South African real yields still much higher than their own history, but they are very attractive against the emerging market peer group and even more so against the poor, predominantly negative, real yields offered by developed markets. As the chart on the left-hand side of this slide shows, South African nominal bonds are the only asset class where we expect higher real returns in the coming years than in the past, regardless of the scenario that plays out in future. As such, we view South African bonds as an asset class that should form an integral part of any portfolio, as the risk-reward ratio is very favorable, with limited reliance on our forecasting ability of which scenario is most likely to play out in the coming years. Although the right-hand side chart on this slide shows that the expected real return from South African inflation-linked bonds are only anticipated to be higher than history in the best-case reflation scenario, in green, anticipated returns are only slightly lower in the other two scenarios, making local inflation-linked bonds also an attractive asset class to include in portfolios for the coming years, as returns aren't overly sensitive to different scenario outcomes. Due to aggressive rate cuts by the South African Reserve Bank in 2020 in response to COVID-19, prospective South African real cash yields have fallen close to zero, which is almost 1.5 standard deviations below its historical average. Even with rising policy rates expected in the coming years in both our base case and best case scenarios, we only expect slightly positive real returns from local cash in the medium term across all three scenarios, making South African cash an universally unappealing asset class. Sector fundamentals in the listed property sector currently remain weak, with rising vacancies, particularly in office and retail, falling escalations, negative rental reversions, and sharp rises in operating costs, the order of the day. However, listed property values have already declined by 9%, discounting a large chunk of the poor fundamentals. As we think total declines will be 10 to 15% peak to trough, the expected limited further property value declines from here point to some return upside for the asset class in coming years, despite the many uncertainties currently prevalent in the sector. In contrast to the case for South African nominal bonds and ILBs, it is only in the worst case deflation scenario in red where we would expect attractive real rand returns from global bonds, fueled by declining bond yields and sharp rand weakness. In both of our base case in blue and best case in green scenarios, we think global bonds will be an asset class to better be avoided from a return perspective in the next few years. This is even more so the case for global cash, where regardless of which scenario plays out in the coming years, the real rand returns from global cash are expected to be particularly poor. Following on from our analysis of the likely real returns available from the different asset classes across the three scenarios, it is then possible to get a sense of the beta market returns investors could expect from a typical multi-asset fund in the coming years. For this, we can use the current median allocations of South Africa's large asset managers to the different asset classes, in conjunction with our own expected asset class returns across the three scenarios. From our results, it is clear that future market returns from a typical balanced fund are likely to be lower than historically in both our base case in blue and worst case in red scenarios. To enhance fund returns to resemble past levels in these scenarios, our portfolio managers will thus have to pull all available alpha levers. These include making use of dynamic asset allocation, adding alternative asset classes into the portfolio mix, as well as choosing the right strategies and mandates. Finally, let's summarize which asset classes we think are likely to give the best and worst returns in each of the three scenarios in the next few years. In our muddle through base case scenario, we expect the strongest real returns from global and South African equities, as well as South African nominal and real bonds, with the lowest returns coming from commodities, global bonds, and global cash. The results in the reflation best case scenario are very similar, with emerging market and South African equities together with South African nominal and real bonds providing the highest returns, while the return laggards are likely to be commodities global fixed income, and global cash. But the return profiles in the worst-case deflation scenario look somewhat different. While South African nominal and real bonds are again among the highest return assets, as was the case in the other two scenarios, they are joined by global fixed income, with the weakest returns in deflation expected to come from South African listed property and global and South African equities. So there you have it. I hope I have been able to illustrate one important way in which we future-proof your investments by making widespread use of scenario analysis within our outcome-based framework to construct portfolios. With this methodology, we think we have the highest likelihood of achieving our clients' goals in terms of returns and risk appetite, regardless of the future scenario that ultimately prevails. Because, with us, investing is personal.
Well, next up is a comfort break. And this is also an opportunity for us to show you a short video as to how Momentum Investments puts the heart back into investments through partnerships with financial advisors, institutional consultants, and its clients.
Some institutions are born for greatness. Places like Groote Schuur, where many great innovations have happened and still do, because they've created an environment where people work together. It was here that on the 3rd of December 1967, Christian Nettling Barnard transplanted the heart of accident victim Denise Darvel into the chest of Louis Washkansky.
We did not realize at that stage that the first transplant of the heart would make such tremendous news. The only time that I realized that I was doing something different, and this was really the moment of truth, is when I looked down into the chest of that patient and there was no heart.
After studying at UCT, Chris put together the team that eventually performed the revolutionary operation.
And when the blood came back into that transplant heart, immediately it showed life. And eventually when I shocked it, it started beating. Everybody started talking and everybody was it was very emotional.
At the time, it seemed revolutionary, but in time, it would become the norm. Momentum is a place where people work together, in partnership with advisors, to create innovations that make a difference in people's lives. Just like Chris and the team, we at Momentum are purpose-driven, as we believe people don't invest for the sake of investing. People live for their dreams and aspirations, and all that matters is to achieve their unique goals. Just as the team at Groote Schuur were there for Chris Barnard, we at Momentum Investments are here for you. We believe in the partnership between you, your financial advisor, and ourselves, and together we will strive to make your dreams a reality. We follow a philosophy that puts the heart back into investments, and together we create the unstoppable force of momentum.
Up next are Tama Gelisito and Zisanda Gila, two senior fund managers in the fixed interest team at Momentum Investments. Zisanda is also a multiple Raging Bull Award winner for the Momentum Enhanced Yield Fund, which is a money market fund. Tami and Z discuss the exciting developments in the fixed interest asset class, the trends and the opportunities seen across the various fixed income yield curves, and how they think about and are managing their funds to take full advantage of developments in this exciting asset class.
Thanks, Gugu. So Z, the COVID-19 period has ushered in an interesting time in financial markets. What have been the interesting trends that you have seen in the front end of the curve?
True, Tammy. The COVID-19 pandemic has indeed brought the financial markets into a standstill around the world. We saw investors globally de-risk their portfolios to opt for hard currencies. During this time, the money market portfolios became safe haven for investors looking for liquidity and stability from less risky assets. We have seen flows into the front end continue as local investors were choosing the safety of money market funds from when the crisis hit to date, even with the lower returns offered by these money market funds.
Interesting, Z. So why were these money markets offering such low rates in this environment?
In line with the 300 basis point rate cuts by the SARB last year, the front end of the curve repriced to low levels we have not seen in over 20 years. This low rate environment continued for better part of 2020 as the COVID-19 pandemic continued to pose a risk to the domestic economic growth until the last MPC meeting held in November 2020. At this stage, it had been clear that the economic conditions had started to improve and the pandemic's threat to growth was subsiding. Currently, as the market continues to expect higher interest rates in future, the average on-screen NCD spreads have been slowly trending upwards across the curve. The money market curve remains elevated beyond the one-year point, with longer-dated yields having improved by more than 100 basis points since the beginning of the year 2021.
Z, that's a very great description of what's happened to date. What's your thoughts on how the markets will play out from here onwards?
Well, Tammy, things are looking up. Economic growth in South Africa surprised to the upside in the first half of the year relative to the same period in 2020. But this is likely to be slowed down by the pending fourth wave of the COVID-19, the commodity prices, and the extent of the damage we have seen from the riots which happened in July. It is our view that inflation is well contained in the near term. The low interest rate environment might continue until the end of the year. This is despite the other emerging markets having started to raise rates. We believe the SARB will delay the hiking cycle until the first quarter of 2022.
I agree with you. We have seen the likes of Brazil, Poland, and Russia start to hike rates. But I think that the SARB will delay hiking rates until the first quarter of 2022. The 300 basis points of rate cuts have been much needed relief for households and businesses. Speaking of businesses, as a money market manager, you also invest in corporate credit. Tell us what has been happening in this space.
Yes, Tammy, that's true. The fixed income market has in the past been traditionally dominated by sovereign bond issuances. The introduction of corporate bonds has subsequently led to other trends emerging. Amongst those trends is the demand for green and sustainability bond, which continues to grow rapidly. The fixed income market is preparing for a big shift and incorporating environmental, social, and governance issues into portfolios where investments typically align to the United Nations Sustainable Development Goals has become a priority.
Agreed, Sisanda. When I look at credit and the credit market, I not only think of us as investors in the market, but also as enablers of businesses to achieve their goals. As you mentioned, there's emerging trends of corporates coming to credit markets to issue bonds that are linked to sustainability. And we as investors are now enabling corporates to achieve more than their business and financial goals. Look, I'm a firm believer that we as investors need to chase returns and invest our clients' money profitably. But I also believe that we need to chase sustainability. With climate change being a reality, if increased and urgent mitigation ambition in the coming years is not achieved, we don't see a sharp decline in greenhouse gas emissions by 2030, global warming will surpass 1.5 degrees Celsius. Speaking of global warming and greenhouse gases, Sisanda, I know you have always been a supporter of green bonds. What are some of the features of these bonds and how much value have they added to the portfolios over the years?
In the famous words of Sir Richard Branson, the founder of Virgin Group, climate change is a huge challenge, but it can be brought in line if governments, businesses, and individuals work together. It has been exactly 14 years since the green bond market kicked off, and precisely 4 years since South Africa launched these kind of bonds. Now, more than ever, the appetite for these specific investment vehicles is growing as investors look for eco-friendly projects. Even COVID-19 could not lower its popularity. Instead, the social theme experienced massive growth in 2020 as issuers turned to the debt market to support the impacts of COVID-19 and its consequences. While most of these green bonds are largely issued by banks, it is increasingly common for corporates now to issue their own bonds. We have seen the likes of Development Bank of Southern Africa coming to market with these kind of offerings.
So tell me, why do these bonds appeal to you?
Firstly, they have an environmental benefit and explicitly contribute to the ESG-related goals. They offer diversification to investors. They generally carry lower risks than normal bonds. They provide transparency to investors on use of proceeds by the issuer and detailed reporting on green nature of the underlying projects. They have lower volatility. They retain their value in the secondary market and are easily tradable in times of tough market conditions.
So Sisanda, do tell us, what are these bonds generally used for, and what green projects have some of these bonds backed in the past?
So firstly, for these bonds to qualify as legitimate green bonds, the issuers must meet certain conditions which are globally known as green bond framework. These type of bonds are used to fund projects which have positive effect on the environment. Some of these projects could be for prevention of climate change by reducing emissions of greenhouse gases, increasing energy efficiency, or improving waste management.
So Sisanda, you did mention that the DBSA has come to market with a bond that is sustainability linked. Can you tell us more about other issuers?
Yes, Tammy. Bringing it home, in South Africa, there has been a good diversification of corporate issuers, including banks, coming to the market. Back in 2012, the IDC came to market and issued a green bond to finance clean energy project. The City of Cape Town bought a bond back in 2018, which was done as part of the solution to the city's water crisis. Nedbank was the first bank to issue a renewable energy bond back in 2019 to deliver financial support to the solar and wind renewable energy projects, which the bank had identified and has 3 bonds on issue to date. The Redstone solar plant in Kimberley, which aims to deliver clean and reliable electricity to displace tons of carbon emissions per year. The most recent one, earlier this year, being the Development Bank of Southern Africa, issued through a private placement with a French institution, and which will be applied to projects that contribute to climate mitigation and promote low carbon economy. And 5 more issuers, including the First Rand, Absa Bank, Standard Bank, Growth Point Properties, as well as the City of Johannesburg.
Wow. As a resident of the city, I am impressed that the City of Johannesburg, a municipality, is also coming to market with sustainability-linked bonds. Enoch Godongwana, the finance minister, recently spoke of the need for South Africa to industrialize. And I think it is important that we industrialize in a sustainable way. South Africa has also been on a path of inclusive growth. Future inclusive growth will be one that considers ESG matters. As the country grapples with inclusive growth, it will be important for Treasury to come to market with instruments that will enable us as fixed income investors to invest in this growth and ensure that we have sustainable outcomes for the country. The recent spate of social unrest experienced in July this year have shown what can happen when a country does not achieve growth that is inclusive. Sisanda, thank you for your insights today. And I hope our audiences will better appreciate the need for incorporating ESG and SDG in fixed income investing.
Thank you. Thanks to you, Tammy, for the engaging conversations.
Passive and smart beta equity investments have been gaining traction as a mainstay component of investments. Lofty Botha, smart beta fund manager, and Imtiaz Mohammed Ali, smart beta co-fund manager in the systematic strategies team at Momentum Investments, both will talk about the evolution and the trends in smart beta and factor investing. Now, as an old hand in these investments, Lofty has been part and parcel of these developments, and he'll discuss how this increasingly sophisticated and rigorous area of investment management grows and evolves, drawing from both global and local learnings.
Thanks, Gugu. Good morning, everyone, and welcome to the Smart Beta session of the conference. In this half an hour, we will give an introduction to Smart Beta investing, discuss global and local trends in the industry, discuss the main Smart Beta strategies and give examples of how they impact on individual shares, and discuss important considerations for formulating an optimal investment strategy. Then we will conclude with the outlook for Smart Beta investing in South Africa. Let us start by saying upfront that smart beta investing is not about having a black box filled with complex formulas. Smart beta fund managers look at exactly the same input that their traditional colleagues look at. However, there are a few differences in their approach. They prefer to have objective numbers rather than subjective opinions to make decisions. For example, they would base investment decisions on quantifiable financial data rather than on an upbeat view expressed by management. While their traditional peers also often embrace style investing, smart beta investors explicitly exploit investment styles such as momentum, value, and quality. It may be confusing that smart beta investing is sometimes referred to as active quant or factor investing. While they all mean the same thing, it is useful to know where these different names come from. Let's start with smart beta. Beta was originally an academic term that referred to the impact of the market on the movement of a share or a portfolio. However, people soon became smart enough to realize that when specific investment styles come into or go out of fashion, they also move share prices. This means share prices are exposed to both market and style betas, and hence the name smart beta investing. The term factor investing puts the emphasis on these investment styles. There is a huge and growing body of research that A, underscores the logic on why a specific style works, and B, provides evidence based on market data that it worked in the past. The term active quants has two dimensions. Active, in this sense, means deviating from a benchmark, as opposed to passive, that refers to tracking a benchmark. Quant, again, refers to the use of quantifiable data, as opposed to qualitative information. This brings us to different approaches to investing in the smart beta space. One of the main differences is between single-factor or multi-factor funds. While a single-factor fund based investment decisions on a single style, a multi-factor fund combines styles in one offering. Multi-factor funds can in turn follow two routes to diversify over styles. For the bottom-up method, each share is individually viewed through multiple style lenses and need to tick multiple style boxes simultaneously to be included in the fund. The top-down method blends a few underlying single-style portfolios to get exposure to multiple styles. An example of a fund that successfully follows this approach is the Momentum Core Equity Unit Trust. Another difference is that some funds track a smart beta benchmark, while others follow a more hands-on active approach. For the funds that track a benchmark, a lot of hard work is done up front, which is then followed by a set and forget index tracking approach with fixed rebalancing dates, etc. Funds that follow a more active approach consider new input data and market conditions on a daily basis. They do not rebalance on predetermined dates, but as and when needed. This helps especially with scalability, as large trades can be phased in. Portfolio managers who manage global versus local funds would also need to follow different approaches. There are thousands of global shares to choose from, while in South Africa there are less than 100 liquid stocks. This means a smaller number of stocks can be included in a local portfolio. When a portfolio contains thousands of stocks, company-specific risks can be diversified away. However, if a portfolio only contains 30 or so stocks, each decision counts. Arguably, it requires more skill to manage a local smart beta fund than a global one well. It requires better risk management, as two related companies may share the same destiny, and having both in the fund may double the risk. Then I've yet to find the perfect database. A minute portion of suspect data points may not have a material impact if one includes thousands of companies in a global portfolio. However, if a fund owns just 30 companies, and one of these companies is included due to suspect data, one is in for a big surprise. The local fund manager also needs to keep an eye out for corporate actions. A single corporate action, such as an unbundling or buying out of minorities, may have a profound impact on fund performance when only a few stocks are held. Let us take a look at what is happening in the smart beta space in the world. While segregated fund data is not as easy to come by, figures from exchange-traded products tell an exciting story. According to Morningstar and S&P, assets invested in global factor ETFs exceeded $1.2 trillion last year. This was thanks to growing by 20% a year over the last 7 years, since 2013. The question is, what is behind this phenomenal growth? According to FTSE Russell's 2019 Global Asset Owner Survey, there are 3 main reasons that motivate asset allocators to invest in these products. The main reason, take note, was to enhance returns. This was followed by risk reduction. Portfolio construction technology is a developing science, and asset allocators are realizing the benefits of diversification over multiple styles. Then there is the added comfort that smart beta portfolio managers do not do style drifting. Interestingly, the attractive fees charged by these products ranked only 3rd in terms of motivation to invest in these funds. There is also a natural progress in the thinking process of investors. Investing into tracker funds opened the door to thinking about smart beta investing. Then, smart beta investing became more and more associated with traditional investing rather than with passive investing. Investors starting to realize that smart beta investing is not about the black box, but about doing the same things that traditional guys do, just in a more systematic way and ignoring subjective information. Finally, the higher growth of multi-factor products within the product spectrum boosted growth for the whole sector. What about the trends for smart beta products in South Africa? We analysed unit trust data provided by Morningstar. Over the decade from June 2011 to June this year, assets invested in general equity unit trusts grew from 130 billion to 380 billion by almost 3 times. However, assets invested in the smart beta segment within the general equity unit trust space grew 15 times, from 1 billion to 15 billion, taking their market share in the general equity space up from 1.3% to 4% over the decade. While the general equity unit trust category grew assets by 11% per annum, smart beta assets grew by 31% per annum, a big figure in anybody's book. In the global space, the motivation to invest in smart beta funds were return enhancement, risk reduction, and low cost. Let us investigate if these drivers of growth are present in the local markets. The 2019 survey, which we discussed earlier, suggested that pleasing performance was the main motivator for investing in these funds. Of the 180 South African general equity unit trusts that had a 3-year performance track record at June this year, 20 were smart beta funds. A simple analysis of the performance quartile dispersion of these funds show that smart beta investors generally receive performance that was either in line with or better than what was delivered by the rest of the funds in the universe. At the upper end of the spectrum, smart beta funds performed in line with other funds in the general equity category. 25% or 5 out of 20 delivered top quartile performance. However, 35 delivered second quartile performance, meaning that they were overrepresented by 10% in the appealing second quartile. And only 15% of smart beta funds delivered bottom quartile performance, meaning that they were underrepresented by 10% in the least appealing quartile. The implication is that without doing any in-depth analysis, investors who picked a fund or funds purely because these funds followed the smart beta strategy would in all likelihood be better off than investors who picked any fund at random. There is certainly a case to be made that performance may be a consideration to invest in smart beta funds in South Africa as well. This slide shows the 5 smart beta funds that delivered top quartile performance over the 3 years to June. The Momentum Trending Equity Unit Trust, Signia's Divi Index Unit Trust, Momentum's Value Equity Unit Trust, Satrix's Divi Equity Unit Trust, and Stanlib Enhanced Multi-Style Unit Trust. All outperformed the average peer by a significant margin. While there are double the number of multi-factor funds than single-factor funds in South Africa, 4 out of the 5 top performers are single-factor funds, while only 1 is a multi-factor fund. The reason for this may be that multi-factor funds, being diversified over multiple styles, would deliver smoother returns, while single-factor funds can be expected to be more cyclical. The FTSE Russell survey mentioned that the second driver of growth is risk reduction via diversification. There is a growing consensus that the best way to achieve a targeted investment outcome is not about deciding whether a traditional smart beta or index tracking approach is superior, but rather about diversifying over multiple product styles. This allows the construction of an optimized solution that gives clients exposure to the strengths of each approach while simultaneously ensuring smoother returns and lower risks via proper diversification. Smart beta unit trust investors are spoiled for choice. The FTSE Russell survey mentioned that the third driver of growth is attractive fees. Based on analysis of Morningstar figures, local smart beta funds also offer value for money, just like their global counterparts. While they are slightly more expensive than cap-weighted tracker funds, they offer the opportunity to deliver superior performance just like traditional funds do, but at a lower fee. And we all know what the impact of higher fees can be over the lifetime of an investment. As the global drivers of flows into these products are alive and well in South Africa, the attractive local growth should come as no surprise. Let us now spend some time on the different smart beta strategies and look at why and how they work. Trending or momentum strategies appeal to investors who believe the trend is your friend and cut your losses and let your profits run. But why does it work? Herd behavior happens when leaders identify new information and act first, starting a share price to move. Then followers react and the trend manifests itself. Anchoring happens due to perceptions on what a company's value should be, and this perception is anchored in the minds of investors. As new information becomes available, some release the anchors first and others follow, and again a trend starts. The momentum trending equity unit trust is a good example of a fund that follows a momentum strategy. It considers price and earnings momentum to invest in shares, and despite the momentum style not being in fashion right now, it delivered excellent performance over a longer than 4-year period since inception back in April 2017 to end of August 2021. Value strategies appeal to investors who believe one should buy low and sell high, or in Warren Buffett's words, price is what you pay and value is what you get. The strategy works because shares of riskier companies often decline to levels cheap enough to compensate investors for the risk taken. Opportunities are often created due to excessive sentiment and due to normal cyclical behavior. The Momentum Value Equity Unit Trust is a good example of a fund that follows a value strategy. It invests in stocks that are attractive based on parameters such as earnings, dividend, and free cash flow yields, and also price to book and price to sales ratios. It delivered excellent performance since inception back in April 2017 to the end of August 2021. Quality strategies are particularly suited for investors who like to buy and hold long-term winners. We consider companies that are profitable and stable and who do credible financial reporting as high-quality companies. The strategy works because if a company is profitable, it means it is using its resources well to produce earnings. If this earnings is of a stable nature and of high quality, earnings would keep growing and share prices would follow. The Momentum Quality Equity Unit Trust that was launched just 2 months ago is a good example of a fund that follows a quality strategy. It invests in stocks based on an array of profitability and stability ratios, as well as on earnings quality. I will now hand over to my colleague Imtiaz, who will discuss 3 stocks as seen through a smart beta lens. Thank you, Imtiaz.
Good morning, everyone. Today, I will be going through 3 shares which we currently hold in our smart beta portfolios. The first of these shares is Capitec, in which we have an overweight position in our trending equity portfolio. The value add year to date from Capitec is 0.5%. Over the last 5 years, the company has had a strong run with an average annualized return above the benchmark of 21.8%. Due to the strong growth in new customers, the company has managed to significantly grow its earnings over the same period with an average annual growth of 19.7%. In the latest company results, the themes that played out was, firstly, banking clients continue to search for better value, and we know Capitec to offer good value, especially to customers in the lower income segment. Also, funeral plans remain a priority for clients. Between December 2020 and February 2021, the company experienced elevated death claims, but the trend has normalized towards the end of the year. Currently, 37% of all new funeral policies are done through Capitec, and the company has an overall market share of 16%. The company has a strong capital adequacy ratio of 37% and has resumed paying dividends. No interim dividend was paid in the prior period. Looking at the graph for the last 5 years, one can see the strong outperformance relative to the benchmark. The arrow in red indicates how that trend has continued from December 2020 up until August 2021. The next share I will speak about is MTN, which we have an overweight position in our value equity portfolio. Year to date, the value add that the share has contributed to the portfolio is 1.7%. Looking back at 31 December 2020, the company had a strong free cash flow yield, which was almost twice that of its historic average. Furthermore, the company also looked attractive on both a price to book valuation as well as a PE ratio, which was at 8.6 relative to its historic average of 16.4. One of the biggest hurdles that the company had in the past was the repatriation of cash from the underlying subsidiaries, especially Nigeria. However, with the latest results for the 6 months to June 2021, MTN announced that they have managed to repatriate 9.3 billion in total from its underlying subsidiaries, and 4 billion of that came from Nigeria. Even though no interim dividend was declared, the board of directors has confirmed that a minimum dividend of R2.60 will be paid for the financial year 2021, with the possibility of a special dividend as well as potential share buybacks. MTN has also announced that they have an asset realization program through which they will sell certain assets. In the first half of the 2021 financial year, the company sold assets to the value of 1.8 billion. The proceeds from this sale will further help to de-gear the balance sheet. The directors have also taken decisive action to exit certain markets where the risk of operating have become untenable. One such country is Syria. Fortunately, the earnings from Syria represented less than 1% of group earnings. When one looks at the graph of MTN, you can see how the value unlock has played out as the fundamentals have improved. The final company I will be discussing is Mr. Price. We currently hold Mr. Price in our quality portfolio, and the year-to-date value add to the quality portfolio from Mr. Price is 0.3%. The company has grown significantly with a compounded average growth rate of 19.4% over the last 35 years. Mr. Price has a lower debt to equity than most companies, as well as a return on equity which has consistently been above 20%. The company also has been growing steadily in its operating margin, which is currently at 17.5% versus the universe average of 10.7%. An update of the latest results for the financial year 2021 shows that the company has increased its market share by 150 basis points. Online sales have also been growing strongly, and revenue contribution from online sales almost doubled compared to the previous year. Mr. Price has also made some strategic acquisitions. The latest of these was that of Yappy Chef as well as Power Fashion. Relative to other clothing retailers, Mr. Price has always preferred to keep credit sales low. The lower credit sales have meant that the company bad debt levels are kept under control. Currently, credit sales constitute less than 15% of total sales. And finally, you can see the Mr. Price graph and how it has outperformed the benchmark from the beginning of the year. I will now hand over to Lofty. Thank you.
Thanks, Imtiaz. Once the decision has been made to invest in smart beta products, one needs to determine an investment strategy that has a high probability of achieving one's investment objective. It is quite helpful to look at the longer-term risk and return profiles of each of these three main smart beta strategies. We used a combination of back-tested and actual return data for this exercise. While returns may arguably be overstated, the strategic lessons that can be determined from this exercise are very helpful. This chart shows rolling 12-month returns relative to the benchmark that can be achieved by following a trending strategy. In the long run, the outperformance was on average above 5% per year. However, the relative return stream is highly volatile. Sometimes the strategy lagged by around 10% per annum. While one may feel an urge to sell the product after a period of underperformance, the chart shows that one would have sold at exactly the wrong point. actually at the point that one should have purchased. In our view, the best game plan for momentum investors is to stay invested. When the strategy does well, enjoy the ride. And when it underperforms, one may be doing well to buy the dips. This chart shows the rolling 12-month relative performance that can be achieved by following a value strategy. In the long run, the outperformance was again around 5% per annum. However, just like with the trending strategy, there were times of severe underperformance. Just like for the trending strategy, it is again the best game plan for value investors to stay invested and to enjoy the ride when the strategy does well. And the best buying opportunities again presented themselves after periods of severe underperformance. The same lessons hold also for a quality strategy. Investors get rewarded for staying invested, and buying the dips again presented opportunities. Our preferred strategy, however, is to follow a diversification approach. This chart shows the relative returns that are achievable by investing via a multi-factor approach. For this exercise, we assumed that a parent fund invests 25% of his assets into a trending, value, quality, and a tracker strategy. The analysis shows that thanks to diversification over multiple styles, and including an index tracking component, a much smoother return stream is possible. This table shows the benefits of diversification in numbers. While the average long-term returns reduced slightly to just above 4%, risk was materially reduced. The worst one-year lag that would have been experienced moved from a devastating 17% on a single strategy fund to around 5% on this fund. This is why we believe the best strategy is to diversify by buying into a multi-factor fund, such as the Momentum Core Equity Unit Trust that uses exactly this concept. Investors who prefer to be more hands-on may of course buy into single strategy funds and do the blending themselves. So what is the outlook for smart beta investing in South Africa? We believe service providers will be pushing these products more and more. Smart beta products offer the same benefits as traditional products, but at a much lower cost, as there is no need for a full research team doing fundamental research and company visits. Investors would increasingly realize that they are likely to experience pleasing performance from these products, and that the risk and cost reduction qualities of these funds make them impossible to ignore. Finally, we believe there's a great story to tell. The media would continue to report on new smart beta funds that are being launched, their track records, and on the flows that they attract. Momentum's smart beta products recently got mentioned by Citywire, EBNet, FA News, and FinWeek. This type of coverage would ensure that the growth that was experienced over the past decade will continue. In a nutshell, industry players who do not participate in this space will be losing out.
Well, next up, another comfort break for you, just to make sure that you're able to get your refreshments and, of course, have an opportunity to watch this short video on the Momentum Investments internship program called Phambili, which means go forth.
We're struggling as a country, we're struggling as a community, we're struggling as a society, and I want what I know to make that a bit better.
Being a leader means being able to make a positive impact in someone else's life.
In the last few months, we interviewed 900 students in an effort to choose 2 candidates to spend 18 months in our business. This program is our way of building a tomorrow that will create new timelines for those whose lives we touch and allow them to create their own ripples, changing lives and building a better world wherever the vibrations are felt. Today, we'll meet Paulina and Bafana, and we'll get to know some of their aspirations, their hopes for the future, as well as gain some insights into the difference that strong, focused mentorship and opportunity like this can make in the lives of our next generation of leaders.
My name is Bafana Motsweni. I'm 24 years old, born and bred in Emalahleni, formerly known as Witbank. In 2016, January, I received my results and that I had been accepted at the University of Johannesburg. This was a big move and an exciting time in my life because I got to finally move from Witbank and go to the City of Gold. My parents really played a critical role in my transition and my success in Johannesburg because they allowed me to flourish and they allowed me to be who I wanted to be and rather not what they wanted me to be. I had the freedom and I could really chase my passions with no holding back and knowing that the only person that I could disappoint was myself. I studied and completed my BCom finance degree and I completed my postgraduate diploma in financial markets. So I needed a company that emphasized and that put forward my personal and professional development. On the 27th of July, I got the call that they're offering me the internship, and it really was the highlight of my year. I'm like, this program is for me.
My name is Paulina Muenda and I was born and raised in a very small township called Alexandra. My family means the world to me. I believe they are all contributors to this young woman that I am today. We are driven by the quote of Untata Nelson Mandela that says that education is the most powerful weapon we can use to change the world. In 2019, I completed my BCom finance degree, and in 2021, I earned my degree in BCom investment management at the University of Johannesburg. I believe these qualifications basically equipped me with all the valuable skills in equity investments, interest-bearing investments, portfolio management, and retirement finance. Because essentially that's what I'll be doing in this program. That's what I'm exposed to in this program, which is investment industry. When I first heard that I got accepted for the Phambili internship, I was quite thrilled. You know, it was so exciting. I remember the feeling I had when I stepped into the front entrance of this building. It was almost like I'm living a dream.
I received a call from Momentum saying that I had been accepted. I was overcome and I was overwhelmed with joy.
Our business is all about building a better tomorrow. We're committed to our ethos of doing well by doing good. And part of this means reaching out to individuals, opening the doors of potential for them, and bringing them into our family.
Phambili means go forward. It's about growth and about moving forward.
What this opportunity allows me to do is to know more and educate the people that I know and the people that they know better about money, about investments.
It has made me persistent, driven, and resilient. And most importantly, it has taught me to work very hard against all odds.
If the last 18 months has taught us anything, is that long-held beliefs and ways of thinking can be challenged. And in a short period of time, ways of work and how we use the space around us can also change quite dramatically. Of all asset classes, property has in all likelihood undergone one of the most radical paradigm shifts in how we think about work, shopping, and even living. Lawrence Koikoi, Senior Fund Manager, and Madibana Litswalo, Analyst in the listed property team at Momentum Investments, will talk to us about these recent events and how they have and will likely continue to shape property investments and how they think about managing their funds in this complex and dynamic environment.
Thanks, Gugu. Hello, everyone. It has been just over 18 months since the onset of the pandemic. The initial reaction to curtail the virus by almost all governments has been to shut down the economies. Since the discovery of vaccines in November last year, we've seen the reopening of economies and some return to normality but the impact of the pandemic on property is proving to be everlasting. I'm the portfolio manager in the listed property team. And joining me here today is Madibana, our analyst in the team, to discuss some of the emerging trends we've seen so far in the sector. So Diba, let's start with office. Almost a year and a half ago, working remotely was an opportunity afforded to a very small minority of the workforce.
Yeah.
In November 2019, Zoom had daily meeting participants of 10 million people. But by April 2020, the platform was hosting 300 million participants daily as people are accustomed to working from home.
Yeah.
Has the way we work changed?
Thank you, Lawrence. I think how we work has taken on a different meaning. And for the most part, I don't see many of us going back to the Monday to Friday daily office commute. But having said that, I also don't expect the home office to completely replace our office desk. I mean, the return to office is mostly being driven by the extent of vaccinations and COVID cases. So as COVID cases decline and vaccination rollouts start to increase, we are seeing a gradual return back to the office. In markets such as the UK, Germany, and France, for example, where about 67% of their population are fully vaccinated, that has driven the return back to office. I think in South Africa, that picture is a little bit slower, with about only 15% of our population now vaccinated, but we're expecting the same trajectory going forward. I mean, I think we've adapted to working from home in a very short space of time, and for the most part, very successfully. Morgan Stanley research is currently pointing to about approximately 3 days in the office and maybe 2 days working from home as perhaps a good balance between the two worlds. So around 1 in 3 office workers interviewed who are currently working from home say they're doing so because their employer has already introduced hybrid working. And so, although office workers are coming back to their workplaces, they are still working more days from home on average. And I think it's the sentiment of the hybrid working model that's probably going to continue. Besides that, I mean, work from home has shifted where people would like to live, what their home spaces look like, and how they manage their daily schedule. And I think it's this flexibility of how and where we work, in our opinion, that's here to stay.
And what does this new way of working mean for office demand going forward?
Yeah, so although we are seeing a return to the office, I mean, tenants are evaluating their space requirements. And we've seen some large companies already indicating they need to reduce their footprint. Standard Bank comes to mind, having communicated that their head office and branches will reduce by about 20 to 25% by 2025 as one of the critical levers to maintain cost growth. Since 2016, Nedbank has reduced their office floor space by almost 69,000 square meters, with a medium-term target to reduce space by over an additional 100,000 squares. Interestingly enough, they are looking at only having about 60% of their office staff at their campuses on any given day. But I mean, this space reduction and office consolidation theme is a trend that we are seeing across the board, and we expect some tenants to give back space as their leases expire. This is likely to add further pressure to office vacancy rates, which hit an 18-year high of 15% in the second quarter of 2021, having increased by 3.4% since the onset of the pandemic. I mean, although we cannot ignore the need for a bit more elbow room as companies make way for social distancing in the office space, I think on a net basis, Lawrence, we're expecting this hybrid way of working to negatively affect office demand going forward. Unfortunately, it's not just a work from home story. I mean, the office market in South Africa has been under pressure even prior to the outbreak of the pandemic. An oversupply of office space and muted demand on the back of low economic growth has driven vacancies higher and rental reversions into negative territory, with market rentals just not being able to keep up with in-force escalations. We anticipate that office fundamentals will continue to deteriorate further amidst low economic growth. Incentives to attract and to retain tenants are also likely to remain very competitive. And I guess the work from home trend has only added pressure to an already weak sector.
So retail has been one of the most affected sectors by COVID-19, with restrictions to trading across the globe. At the onset of COVID-19, we saw consumers pantry loading to mitigate the risk of food shortages, curfews, capacity constraints, impacting sit-down restaurants and entertainment. Do you think there's a change in consumer behavior? And if so, how will this impact retail property?
Yeah, so I think beyond the pantry loading, I mean, food grocers continue to print very strong sales numbers. If we have a look at Shoprite's supermarket business in South Africa, for example, reported sales growth of 7.3% on a like-for-like basis. I think a great set of results when you factor in the fact that there was a high base in the previous year, as well as the countless times that the liquor business was restricted to trade. So I think overall, essential services have continued to perform well, even past the initial lockdowns, with some landlords actually seeking to increase the proportion of this segment in their centers going forward. I think what we've also seen is turnover growth recovering much faster than footfall growth. So consumers visiting the malls less frequently, but spending more on their visits. If we look at Shoprite's numbers again, I mean, customer visits declined by 3.8%, but the average basket spend increased by 13.6%. While the picture varies from retailer to retailer and across the different retail formats, footfall to large format centers saw a much more protracted decline. I think we saw footfall down about 30% in the first quarter of 2021. However, it has been encouraging to see an increased number of people heading out into these centers as lockdown restrictions are relaxed.
Does this mean that landlords with higher weighting towards essential services and value offering are outperforming the broader market in retail?
Definitely. I think not only are consumers making fewer visits to shopping centers, but they're also preferring to do their shopping much closer to home. And I think the work from home trend is also adding to this. For the most part, convenience centers, which generally have a bigger proportion to essential services, have outperformed the larger regional and super regional centers. If we have a look at the Fortress Income REIT numbers, for example, retail sales in their convenience centers have come back to pre-COVID-19 levels in June this year, up about 5%.
And Diba, what other trends besides food outperforming are coming out?
Yeah, I think an unexpected trend has been the strong performance of luxury brands. So while long queues at essential stores were expected, I don't think we quite expected the kind of lines we saw outside the likes of your Louis Vuitton at Sandton City during a pandemic. So turnover in luxury brands in the Liberty 2 Degrees portfolio, the owner of Sandton City, was up about 51% in the first quarter of 2021. I think the best performing segment in their portfolio. This is also reflected in Louis Vuitton's half-year results in July, where sales growth increased by 11% on a like-for-like basis. So not just a Sandton City story. So we're seeing the high-end consumer continuing to splurge on retail, perhaps on some retail therapy as travel restrictions continued. But Lawrence, as you alluded to, the sit-down restaurants and entertainment offering in our shopping centers were perhaps the most impacted by capacity restrictions and curfews. Unfortunately, Ster-Kinekor is one of the latest companies to go into business rescue. And I guess the question is whether there's still a place for cinemas in our shopping centers. And I think now with cinemas allowed to operate with greater capacity and a later curfew, as well as some much anticipated movies starting to be released, we are yet to see a recovery in this category. I think sit-down restaurants have been a mixed bag. So unfortunately, some restaurants have closed their doors, but some are still really reliant on rental relief from landlords, while others have actually seen a very strong recovery. So I think although we all learned some culinary skills, we still appreciate the occasional lunch or dinner out with family and friends. In general, we have started to see a recovery in retail sales post the hard lockdown. Unsurprisingly, the pharmaceutical sector saw cumulative growth of about 25%, with home improvement also seeing strong retail sales as we spend more time at our homes. Apparel and footwear, however, continue to lag this recovery, with sales down 41% cumulatively. I think overall, we expect a recovery in the retail market, but continue to prefer convenience retail over regional and super-regional centers. Lawrence, perhaps this dovetails quite nicely into the convenience of online shopping. I personally made my first purchase on the Checker 60 app recently. And according to Nielsen's study, 37% of South African consumers have increased their online shopping. How has this increased online shopping fared perhaps post and during the pandemic?
So the penetration of online shopping is structural. And the UK and the US are probably the most advanced in the Western world. And incidentally, that's where the impact of online shopping on brick and mortar retail has been more pronounced.
Yeah.
Both these countries have seen the demise of department stores by and large. Online sale penetration has tapered off from the peak across all key countries, but it's still higher than the pre-COVID levels. The inflection point of the demise of brick and mortar by online shopping is debatable. But based on this chart and observing what has happened in the UK and the US, we can conclude that penetration of online shopping above 15% could start the challenges in the brick and mortar retail.
And how has supply chain evolved around the structural change?
So more choice has been given to consumers through the internet and smart devices, and more consumer data has been given to the supplier. Therefore, artificial intelligence will continue to evolve the supply chain. Before the advent of iPhone, the traditional way of online shopping was desktop-bound. Delivery to customers and store was sourced from a central warehouse situated just outside a city. But now a central warehouse services the delivery hub within cities based on consumption patterns. These hubs are the last mile delivery facilities, click and collect points and stores itself, and they are all in close proximity to the consumer. That is why less than an hour delivery by clicking confirm order and payment is possible in certain countries.
And the industrial market has been the most favored sector in the recent past. Is there still room for growth, or has this market kind of reached its peak?
Fundamentals in industrial market will continue to be strong for as long as we see increasing penetration of online shopping, absorbing more space than supplied. The UK market is a good example, with occupancies tracking online sales over time. When that happens, rentals grow and consequently valuations grow, like we're seeing in this chart. I think in this instance, we need to guard against overpaying for investments in this sector, while also guarding against deteriorating fundamentals in other property sectors.
In summary, it looks like flexible working hours will be the norm, broadly available to more employees than before. In retail, convenience is the best form of defense to coexist and complement online shopping.
And the industrial tailwinds will persist for as long as supply and demand dynamic remain favorable. And this is how we would summarize the topic for today. These are our final insights into how we manage our funds. We put a lot of effort in managing the downside risk, as opposed to trying to outsmart the market. We believe once we manage the downside, the upside take care of itself.
Therefore, we limit exposure to sectors that are exposed to structural risk. We limit exposure to property portfolios facing cash flow risk and avoid timing the market. And last but not least, we avoid overpaying for investments.
Thank you, Madibana.
Thank you, Lawrence.
Thanks to all of you watching at home and wherever you may be. It's been an absolute pleasure.
After listening to the various specialist capabilities, thought leaders from across Momentum Investments, locally and globally, pull this thinking together and discuss how the evolving and new trends will shape up to craft the investment manager of the future. They also gave us insight on how Momentum Investments will think and proactively prepare and evolve for this future. Now, the panel discussion is moderated by Sonia Saunderson, the Chief Investment Officer of Momentum Investments.
Thank you, Gugu. After listening to the various specialist capabilities, thought leaders from across Momentum, locally and globally, will pull this thinking together in the panel conversation we will be having just now. We will discuss how the evolving and new trends will shape up to craft the asset manager of the future, and just how Momentum Asset Management will think and proactively prepare itself and evolve themselves for the future. But let me first start by introducing our panelists. First of all, our ladies. Sanisha Pakarisamy is our economist at Momentum Investments. Alex Harvey is Senior Fund Manager and Investment Strategist and works in our London office as part of Momentum Global Investment Management. Ian Scott is the head of our fixed income team. Lawrence Koikoi, as you heard this morning, is Senior Portfolio Manager, part of our listed property team. And last but not least, Wayne Dennehy is our Head of Distribution and Systematic Strategies. Welcome, everybody.
Morning, Sonia.
Let's maybe start with a global perspective. Alex, you work very closely with a variety of fund managers in the UK as well as across the globe. More recently, Seneca in the UK has bolstered the UK team's direct capability set. What do you see as the key trends and what are you picking up from a fund management perspective that asset managers are dealing with on a day-to-day basis to help them adjust to a world that keeps changing?
Good morning. Well, I think some of the key trends that we are seeing and have seen have clearly come from the technological shift that's happened during COVID as people have moved to home working, etc. And the embracement of technology to take the asset management business forward and how we do our research, how we develop products, how we take products to clients is a huge trend, and that's only going to continue. In terms of actually sort of portfolio evolution and construction, definitely what we're hearing about and seeing in the global marketplace in London and beyond is how we can build robust portfolios, how we can build resilient portfolios for the future with bond yields being so low. So moving away perhaps from the sort of traditional equity and fixed portfolios into introducing new asset classes and diversifying the portfolios beyond just bonds. So diversification is definitely a sort of key theme at the moment as well. We'll talk about it a bit more, I'm sure, but certainly environmental, social and governance concerns, ESG, and sustainability is really everywhere at the moment in the global marketplace. Very prevalent here in London. We're getting it hearing about it from clients as well as from our managers. So it's definitely from both sides and within as well in the work that we're doing and the products that we want to offer our clients as well. So that's definitely a huge theme. That's really just what sort of one direction of travel with that. And I'll probably just finish up by really saying sort of fees as well and value for money, which are two different things. But there has been this sort of drive to low cost beta solutions, passive management, which has really sort of lowered the bar on fees across the scale in all asset classes and sort of product sets that we operate in as well. And that's very much the case in Europe. It's a very competitive landscape. So there's this sort of balance between fee reduction, but also sort of value for money as well within the active space. So I think they're the key trends that I would probably highlight from a global perspective today.
Okay, and I guess you mentioned the global economy, which of course is very important for us to understand the context, because that really tells us what the opportunity set is within which asset managers need to operate. So Sanisha, I guess that prompts a question for you. How do you see the global economy recovering? And specifically, what do you think it means for asset classes and the kinds of opportunities that would pose for the asset management industry?
Thanks, Sonia.
Well, in our view, even though emerging markets are likely to represent an increasing proportion of the global economy, global growth is still likely to soften, in our opinion, in the next decade as emerging markets really struggle to take up that slack that has been left behind by advanced nations, which are now growing at a much milder pace. We also think that structural reforms in the areas of health, education, and even infrastructure will become imperative to ensure that emerging markets are able to successfully grow their respective middle classes. Now, as we see the economy reopening from this great lockdown, we are going to see short-term inflationary pressures building because demand is now ramping up quite fast against supply chains. But in our opinion, longer-term future inflation is still likely to remain benign. So if we think about this economic picture that we've painted, we do expect market returns for the next decade to fall short of the historical averages that we've seen in the past, given that we are starting from quite an unfavorable point for asset valuations, and we are operating in an environment where interest rates are still at historical lows. So in addition to this, we've also seen competition in the local market really ramping up over time. We've seen the number of domestic asset managers increasing quite dramatically in the past decade. So we're facing increased competition. We know that there is also tighter regulation in a much lower return environment. And we think that this is really going to force investors to start looking at other geographies and even other asset classes to eventually enhance yield. Lastly, we also think that the rise in smart technology can also be used to foster much higher levels of productivity. We think that it can create cost efficiencies, and ultimately we wanted to improve client relations.
Okay, so do you therefore think there are any specific almost super trends or macro trends that are likely to dominate how the asset manager of the future is going to evolve?
So Sonia, a few years ago, really focusing on environmental, social, and governance criteria really gave asset managers that competitive edge. However, these days, responsible investing has become such a necessity to ensure the health and the stability of the market as a whole. And this has really been in line with growing environmental consciousness and just the increased financial sector regulation that we've experienced. Secondly, advanced data analytics are also likely to be employed on a much broader scale and utilized as a strategic asset to improve customization and just to better cater for our clients' needs. But of course, alongside this rise in the use of high-tech infrastructure also comes the rise in cybersecurity risk, and asset managers really have to prepare for this in case of data breaches. Thirdly, increased regulation has also enforced much more transparency around fee structures, and this was alluded to by Alex earlier. And we think that this trend will likely drive the race in lowering fees. And then fourthly, given the lower return environment that we envisage for the next decade, the search for yield could lead to alternative investments becoming far more mainstream in nature. So we still think that traditional asset management is going to remain the core of the asset management industry, but it is likely that funds managed under passive and even alternative strategies will probably grow more rapidly in years to come.
Okay, so clearly a lot of overlap between some of the themes you are highlighting, Sanisha, and compared to those that Alex was talking about. And I suppose there's no surprise given the interconnectedness of our world from a local and a global perspective. We often do see a lot of the trends from a global perspective coming to South Africa with different speeds over time. But let me then go back to you, Alex, a little bit, just in terms of your experience from a global landscape perspective. Where do you think in your dealings with fund managers, are they in the evolution of how they're dealing with these changes? And specifically, do you see any differences between geographies or the sophistication of the markets or the development of the markets in terms of how the asset managers are dealing with it?
So yeah, our managers that we work are based around the world. They're not all, around the corner. All the best managers don't work next to you. So you have to go and find them and seek them out, and particularly for the successes of tomorrow as well. So, but the trends that we've spoken about are impacting particularly the sort of rise in sort of passive investment and low cost index type exposure. Very much sort of hitting some of the bigger players. We've seen a sort of wave of mega mergers between some of the big managers who have sort of consolidated in order to be able to sort of compete at scale. In order to, I think, thrive for the future, you need to differentiate in many ways beyond just performance of your product, probably in client service, etc. as well. But certainly at a product level, we tend to center most of our research in smaller, more sort of boutique type managers, not within what I would term the squeeze middle, where some of those mega mergers have taken place. So that's definitely what we're seeing sort of in the global marketplace. I think picking up on that sustainability trend that we spoke about as well, within Europe, I would say definitely the baton has been picked up more locally to us in the UK and Europe. The European regulation is moving pretty quickly on this, pretty swiftly, in order to help prevent greenwashing, as it would be termed. That's to say, managers or suppliers of investment strategies putting out funds purporting to have sort of green credentials when maybe they're not really up to scratch. So there's a lot of work being done around regulation and certification of strategies under the SFDR regulations within Europe, which is the Sustainable Finance Disclosure Regulation. So we're seeing a lot of movement there, and funds wanting to get certified under that regime and that classification as well. So much going on in that space, and I expect that to continue. It's more than a trend; it will start embedding in products and processes, I think, much more strongly going forward.
One of the key themes that we raised this morning was ESG and sustainable investing. So Ian, let me address a question to you, just in terms of how do you think this is likely to affect asset classes and also investment managers responding to that opportunity set?
Thanks, Sonia. What we're definitely seeing in the world is now the rise of the green movement. We witnessed it a few weeks ago with the Green Party in Germany having the most growth in an election, and we're probably going to see that more in the world. And as we've witnessed in the asset management industry for the last 2 decades, more regulation is coming. So we can work out that when these green parties get into power in governments, they're going to have a green mandate. And that's going to filter down to regulation in the asset management industry. And we will have to choose the path that we're going to take. And because we are funders of the economy and the wheels of the economy, we need to be part of that process. And I think the big change is the way we're going to work. And I agree with what Shanisha said, that core asset management will remain in the way it is. But the way we're going to function is going to be very different. That if you think about a core asset manager, there's an equity component in its isolation, there's a bond component, there's a property component, there's an alternatives component. We all have our own benchmarks and we all have our return targets. I think in the future, it's going to be much more closely aligned. So let's think about an IPP or a sustainable project. So there's an infrastructure phase where the alternative teams and the equity teams get involved. Then there's the construction phase where the alternatives or the mezz debt guys get involved. Then you get the take-on phase where the fixed income guys get involved. And at the end, there's a cash phase maybe where the money market guys get involved. I think in the future, that lines are going to be blurred in a big way. We're going to think about a project and we say, look, guys, here's a big IPP project, a sustainable project, whatever, a housing project, whatever it may be. And you're going to say, look, the equity team, the fixed income team, the property team, we all have an interest to make this work. How do we get it to work? And we all get the returns to our clients on an ESG basis to work. So I think the integration in the teams are going to be very different in the way we traditionally worked in a siloed approach in a traditional asset manager. So the way of work will definitely change. And remember, we're in this transition phase as well. We just can't go and switch off the lights on Eskom tomorrow. There's going to be a just transition. What can we do given the challenges in South Africa as an asset management industry? But I think it's quite important that we understand that we have to be part of the journey because we are the funders of this transition journey.
Yeah, and I guess the move from active to passive and a lot of the cost pressures will in any case force asset managers for their teams to work closer together and get better integration to make sure you leverage resources and skills in the best possible way. But let's think about the sustainability dynamic for a second. I mean, your take on what sustainability will mean for benchmarks and the likely impact on returns. What do you think about that?
So once again, a very solid approach, because if you're an equity team, you've got a CAP Swix or a ALSI type benchmark. If you're in the bond space, it's a Govy or a Silly or a Orbi or a JIBAR return. If you're in Lawrence World, you a SAPI return and and it's very solid again. But in ESG, I think it's going to change, because what we've not seen is that our ESG actually goes into benchmarks, because the asset part of the market is already changing. So a good example is what we are seeing in the bond market at the moment is that we as note or bond holders are giving sustainability targets to companies. And when we say to them, look, if you reduce your carbon footprint or you make some sort of sustainability hurdle, there's going to be a reduction in your coupon or your interest bill at the end. So interesting question is, are we going to have in future, let's call it a STEFI or a JIBAR or all we benchmark that is sustainability adjusted? Because if we are going to give a target to a company to say, reduce your carbon footprint by 30% by 2030, and we will reduce your interest rate bill, that means a lower return to our clients. So the question that we have to ask ourselves and our clients, is our clients willing to take the lower return for having the benefit of the sustainability? Because that's the trend that we're now seeing in the fixed income markets of those lower coupons for higher ESG or sustainability benefits. And it's going to be interesting if that's going to be rolled out to other asset classes as well. So the question would be, if companies meet sustainability targets, is dividends going to be lower? Is REIT returns going to be lower when they put solar PV on the shopping centers? I think that's still an open debate, but we are seeing the progress of that in the fixed income markets as we move forward.
I guess a lot of proponents globally are saying that sustainability doesn't have to come at the expense of returns. So I guess there's a lot of conversation in that area that we still need to have. If we take a slice out of the responsible investing and sustainability themes, and we think about the green investing that you were referring to a little bit earlier, that's certainly a fascinating topic, and we hear everyone locally and globally talking about it. So what do we think it means? It's a growing trend. What do we think that momentum and that trend means for the asset management industry? And maybe, Ian, you can take it with Alex, and both from a local and a global perspective, give us your answers.
Well, for us, it means we're looking for opportunities in that green space. In South Africa, I think we've only started that journey where we are seeing the REIT industry coming to the market with trying to reduce their water consumption, their solar footprint. So we will be investing in those assets, but not to the detriment of returns to our clients at this point in time. So, but are we on that journey? Yes, but we are on a just transition. As I said, we can't just... We love to hate Eskom, we love to hate Sasol, but we can't switch off the lights. So there's a just transition in South Africa. There's a South African reality, an emerging market reality, and we have to finance that reality. But it doesn't mean that we can't set targets to those companies to say, look, by 2030, you guys will have to reduce your carbon footprint by X, your water consumption by Y. I think that's where we're going to, is trying to set those targets and seeing that progress over time of ESG and sustainability. And I would like to hear what Alex says from a global perspective, because obviously if we listen to our global partners, and Rebecca is obviously quite far ahead in this, and what's happening in Europe is, where do they see Europe being in 2030, and what's that global trend? And we're probably going to follow that path because we are a little bit of lag out being in EM and being in that just transition phase.
Alex, your take on the green movement globally and the impact on the industry?
Yes, it's definitely a unidirectional trend in terms of sustainable investing. It took a bit of a breather in 2020. Clearly, other issues, notably COVID, really came to the forefront, and the wave of interest in ESG, momentarily was relegated, but it's very much back at the top of the agenda today in the meetings that we're having with managers more locally in the UK and in London, as well as managers that are operating overseas who we're having Zoom calls with, or slowly starting to have face-to-face meetings again in the office, which is great. But the jury's still out really whether there is an observable and robust and repeatable risk premium that can be associated with this sustainable investing framework. But nonetheless, this is something that clients want, and it's something that we want as well to embed into our products and strategies. And just talking about that, risk premium, it is actually, it's observable in bond markets. We had another green gilt that was issued just in the last couple of weeks. And that is probably trading or came to market trading a couple of basis points tighter than an equivalent maturity normal gilt of the same of the same tenor. So there is an observable greenium, as I say there, which is a sort of green premium, and that is that's embedded in the pricing in markets today. And there's a lot of demand from pension funds and the like for assets like that. So I think we'll see more of that come to market, and I think cost of capital is a big consideration, as Ian mentioned. As clients and investors demand more of that and willing to pay a bit more for it, then arguably returns, certainly from fixed investments, will edge a bit lower on the back of that. So there's a balance between the return side of it and obviously the sustainability credentials of what you're investing in as well. We expect that to continue and to embed in market pricing and in products that are in the marketplace.
And I love that term, greenium. Certainly a whole new world of terminology that's coming to the fore as a result of it. Green and premium together. So thank you for that, Alex. We're certainly seeing a lot of challenges, things that we need to respond to today, but to address the problems for the future. So let me move to you, Lawrence. The pandemic and the technological advances have shifted the demand from the real estate asset classes to a large extent. How do you think investors should think about investing in the asset class, given the development that's unfolded the last couple of years?
Thanks, Sonia. The challenges for SA REITs have actually preceded COVID, and you can trace them back to December 2017, unfolding with the resilience scandal. So if you look at it that way, it's been a downward hill up to COVID, and then COVID just accelerated the impact on offices and retail. So from our side, we avoid painting the sector with the same brush. And I'll give you some examples into our thinking. In SA, metro retail is underperforming non-metro retail. And that's clearly a consensus in the market. And that's the reality we face. But within the metro retail, convenience is actually performing quite well, and in some instances performing on par with non-metro retail. So we would look at companies with portfolios that are skewed towards convenience retail, but have been indiscriminately priced as if they are non-metro retail. So the second example I would give to you is the UK and Europe. So in the UK, online sales penetration has been relentless, reaching about 30%, and at the peak of the pandemic, but it's tapered off, but it's still high. And at the same time, we saw a wave of tenant failures coming along with that. But then if you look at Europe, we haven't seen similar level of tenant failures coming through, but you have retail portfolios that are priced as if they are UK portfolios. And if you look at countries like Portugal, Spain, you do have instances where malls are holding up well and limited tenant failures. And that's why it calls for us to follow the facts. and assess whether the facts are correct and build conviction, and we act upon that.
Okay, so you're talking about retail there from a global perspective. Give me a little bit of your sense of what's happening in our sectors and specifically maybe with the retail sector.
So the retail has been at the forefront of COVID. So at the height of the hard lockdowns last year in April, you'll recall that only essential services tenants were permitted to trade. Things like pharmaceutical, food. So from that side of retail, it's been resilient, and spend continues to be directed towards that side. And then restrictions have been lifted. We've seen improvements in trade, but trade is also directed to the value offering within the non-essential part of retail. And that's the trend we continue to see today. Unless we see a strong rebound in economic growth, I think you will still have instances where the spend is skewed towards more towards value and essential services.
Okay, and of course we cannot talk about the property sector without thinking about the office segment and what COVID has done to the office sector in general. So maybe, I mean, first of all, who would have guessed that we all would have worked from home for the last 18 months? It's just been unbelievable. And talking about the asset manager of the future, I mean, the asset management industry also had to adapt to it. But from your perspective, the work from home environment and its implications for the property sector, what do you think about that?
So the work from home dynamic is quite interesting. Locally, our office challenges actually precedes COVID. Right now, office vacancies are at 15%. They were last at 15% in the early 2000s. And from early 2000 leading up to the global financial crisis, we saw a compression in vacancies from 15 to 5%, also driven by the strong economic environment which happened during that time. So we faced with the similar levels of record vacancies in the sector. But obviously, COVID has introduced another dynamic, which is work from home that you're alluding to. So that's probably taking away any potential rebound should economic growth come back. And tenants have been emboldened to optimize costs by this work from home dynamic. So from an SA perspective, it's probably more driven by cost optimization, weaker economy, unemployment, more so than you'd say corporate cultural perspective like you're seeing offshore in the US or UK and Europe. So work from home, it's probably still going to be a dynamic that will be with us probably forever. But I think we will probably settle on a flexible model. And I think that's probably a consensus. And then the negative on our side as well is that not everyone is well equipped or set up at home. And we've got challenges of load shedding coming back, and that obviously provides some sort of relief for office landlords.
Okay. Well, let's change the focus a little bit to one of the key trends that we chatted about earlier and that both Alex and Sanisha raised, and that is the move to really from active to more passive and smart beta strategies. I mean, Wayne, one of the key reasons why we structured our business around a smart beta equity capability was that we wanted to be ahead of this trend. We wanted to make sure that we've got offerings that are low cost but well performing that investors can use. And although we were a little bit ahead of the trend and we only saw the growth, the phenomenal growth from a global perspective, we are certainly seeing that trend coming to South Africa and a big drive over the last year or two. Maybe a question to both you and Alex is, what do you see, first from a local perspective and then maybe Alex from a global perspective, What are the key trends in this space that you are picking up?
Thanks, Sonia. So I think let me start. If you want to have a look at the trend, maybe we should go back 5 or 6 years. And if you look 5 or 6 years ago, this market was very, very complicated for clients. I mean, these building blocks were called smart betas, enhanced betas, scientific betas, factor-based investing. It was very complicated for clients and even for us, honestly, to try and understand what these subtle differences might have been. I think what we have seen is that of late, there's certainly heightened institutional interest in these clients, which for me is really exciting, that the institutional clients are now starting to actually come on board. I think from a fee perspective, and we've heard that more than once this morning, right? We've heard fees from Ian, we've heard fees from Sanisha, that they're under pressure. Fees is the one place that smart betas really are competitive because they offer cheap access to market risk premiums. And then I think it really comes down to how do we think about and what's happening in the market when we actually think about execution in these smart beta funds? Because I think one of the criticisms is sometimes clients and sort of various analysts see them as just being a Shift F9 fund. It's a rules-based, I press Shift F9 at the end of the month and here's my new fund. And that has massive dangers for clients, right? So there is a lot of smart IP that needs to be behind these strategies in terms of actually applying it and seeing what sort of tweaks we need to make to our process. And the final theme really, and we heard that more than once on this panel as well, is how does ESG play out into our smart beta fund? So I'd say those are the primary themes locally.
Okay. Alex, and on your side, any global smart beta trends you would like to mention?
Yeah, when it comes to the global marketplace for smart beta type strategies, I think they've taken a little bit of a pause. Maybe there's been a huge amount of growth in the market in Europe and in the US. I know in the last decade or more, it had been in the ascent. There's a lot of products that have been built around smart beta type strategies. We've had smart beta ETFs here for a good number of years now as well. So a lot of money had flowed into that space. Feels like it's taken a bit of a pause, and perhaps rather than product that is sort of single style strategy, it will probably move into more into blend solutions, and the importance of blending, something that we've done, we've been practicing in our equity portfolios for years now. We think it's very important to blend those styles and manage the risk of any single style into a blended solution, and the benefits are clear. So I think more work will evolve that way, perhaps around sort of timing of styles as well. We don't actually think that's a high quality decision. We think it's very hard to time styles, but nonetheless, it is a lever that managers and people offering products in smart beta space will be able to employ. And we believe in sort of tilting and pivoting around that rather than sort of wholesale timing, as I would say. I think what is very interesting is what's going on in the fixed income space, or what may in future sort of come through. Fixed income, be it credit rates, it's traditionally it's an OTC market, so there is not as much, considerably less observable data around pricing, around spreads, volumes, etc. Much less of that than there is in the equity markets and public equity markets. So the research is much further behind the curve in fixed income markets. But I do expect that to advance. There are strategies out there that are smart beta fixed income. There's a few in credit. There's a number in rates. And in fact, our own sort of Momentum Global Fixed Income Fund, we've redesigned that, and that's a much more systematic strategy today that offers global sovereign rate exposure at a lower cost to clients. So a lot of work going on there, and then I guess and certainly in asset allocation as well. We are well accustomed to in the UK here now. What I would call sort of robo advice, which is purporting to be, if you like, sort of systematic strategic asset allocation. Not really rocket science stuff, but it's very prevalent and definitely out there. And perhaps the next sort of frontier is moving more into sort of tactical asset allocation, and timing of asset class selection beyond just the purely sort of strategic level. So that's an area to watch, and that clearly sort of dovetails very closely with everything that we do, both in London and in South Africa.
Yeah, that's certainly an interesting space to watch and something that will be of relevance to us as well in South Africa. Wayne, maybe just getting a little bit closer to the way we implement it in South Africa and how we think about the advancement of our portfolio offering. A little bit to you, how do you think we adapt to these challenges and some of the opportunities Alex was also talking about? How do you think about the focus areas for the Smart Beta team at the moment? You talked about ESG and sustainable investing. I mean, how do you think about integrating that in the portfolios going forward?
Well, Sonia, I think certainly, and we heard it now from London as well, the key to building out a more sustainable equity building block is to have a well-diversified building block. And in SA equities, to be well-diversified, we mean well-diversified between the various local styles. Styles of equity, styles of value, and styles of quality. And it's by blending these styles together that the real magic happens. I think it hasn't been any surprise to anyone that if you were invested in one of these styles for the last 10 years, it would have been a white-knuckle experience. It would have been fantastic times and absolutely horrid times. So the way we can actually build portfolios that are going to behave better through unknown future waters is to actually blend these various styles together. So I think that's a key theme and certainly how we think about building out our particular SA equity building blocks. And then I think from a sort of ESG perspective, I mean, we certainly consider ESG on all three pillars, right? So we're looking at it from a sort of a like governance perspective. So sort of a strong proxy voting on all the shares we hold, being very active with our sort of various management teams from an environmental perspective and from a social perspective. And this is where the market's trying to actually find its feet now. I mean, we've heard from Ian, should we be looking at new benchmarks that are actually ESG adjusted? I think that actually works very well globally, but here we don't have as many shares. If we start filtering out 10% of the market, we're going to get some really strange looking benchmarks. And the primary theme I'm hearing more and more now is actually climate. I mean, not a theme I heard 5-6 years ago, but now we're looking at sort of like climate reports from BHP Billiton, from Standard Bank. And to me, ESG is actually a completely evolving space right now. And for us, it's about being very active, being very vocal, and making sure that we're operating at the very front of this exciting space.
Okay, Wayne, so clearly the fact that we are signatories to the UNPRI and the TCFD is also playing out in the Smart Beta space. So thank you for mentioning that. Sandisha, back to you. You've heard everyone, all the different views. You as our economist, how do you think we should as Momentum Investments, and in particular Momentum Asset Management, how should we adapt as an asset manager to be of relevance going forward?
Sonia, I have to say that I'm very excited about the future. I think it will be important for us to manage our clients' expectations in this lower growth, lower return environment that we have been sketching out here today. As such, providing tailored advice and customized products to our clients in the most cost-effective way could help us to keep Momentum Investments as a relevant business in this industry that continuously changes. We also have to ensure that we are a solutions partner and remain as such, and not just a product provider. And that will help us to be able to orient the business around our individual clients much better. At Momentum Investments, our alternative investments, passive investment strategies, and even our smart beta capabilities help us to ensure that we are protecting our clients against market volatility, enable us to diversify their portfolios, and to be able to enhance returns ultimately. Secondly, given the likelihood of asset class returns not really being able to beat the historical averages that we have experienced in markets, I think it will be quite important for us to maximize the growth areas that we have identified and to be able to look to other geographies and even other asset classes to boost yield and investment returns in order for our clients to achieve their financial goals at the end of the day. And then thirdly, embracing and investing in digital transformation will also play a key role to enable us to increase our client engagement, to lower costs, and to improve our investment capabilities and reinvent our platforms. We heard Alex mentioning earlier on things around robo-advice, and this is really where it all fits in. But at Momentum Investments, machine learning, big data, and artificial intelligence, AI, form quite a significant part of our research team's focus. And this is really because staying abreast of the trends that will define the future of investments remains very important for our business. And then lastly, creating an environment that really promotes knowledge sharing will help us to accept behavioral change in the business. And this will ensure that Momentum Investments keeps agile enough to adapt to a changing environment.
Well, clearly you can hear that our investment team are thinking about much more than just the daily portfolio management. They are inquisitive, they are driven, and they constantly seek out, interrogate, and challenge. The key to the investment success is your people. Having the right people with inquiring minds and always looking, researching, and thinking about the future. From our discussion, the main trends likely to affect the asset management industry remains to be the pressure on costs, the search for returns in a lower growth environment that a lot of our panelists talked about, the move from active to passive and the lower cost smart beta offerings, the need for alternative asset classes and how we mingle the traditional investment managed approach to better integrate our alternative skill set with that. Then the use of technology clearly is a key trend shaping the investment industry, as well as the integration of ESG and responsible investing into these portfolios. Our response at Momentum, as you heard from the panel, is to continue improving our integrated approach towards long-term sustainable investment practices through innovation, learning, and global best practice. But it is a journey, and we have therefore invested in research, partnerships, and technology to help us in the evolution of this approach and to ensure that we are empowered for the future. Thank you, panel, for sharing your wisdom.
Thanks, Sonia.
Thank you.
Well, that brings us to the end of day one, and we thoroughly hope that you've enjoyed the first day of our conference. We look forward to seeing you tomorrow, where the focus will be on all things alternative investments. We'll see you then.